All right. Thanks everyone for joining me this afternoon. My name is Tony Zhang. I am the Chief Strategist here at Options Play. And today we're going to be talking about how to hedge your portfolio using options. So just a quick sound check. If you can hear me, please type yes into the chat window. Okay, looks like you guys can hear me. Great. So today we're going to be talking about a topic that was probably a little bit more relevant 2 to 3 weeks ago than it was today. Markets were substantially different 2 weeks ago when we thought the markets had the possibility of correcting lower. Things like North Korea and interest rates were a concern of ours that seems to be a slightly less concern today. So I will say that perhaps this topic is slightly less relevant than it was, but I do think the information that we will present to you guys today will be useful in the future whenever you do may have the feeling that the markets will correct. This webinar is going to be a bit more advanced than most of the normal ones that we do. So for those of you that are brand new to options trading, I'm not going to get into too many advanced topics, but you may have a little tougher time to follow along. So this webinar is recorded. The slides and the recording will be sent to you once we're finished with the webinar. So I highly recommend, if you're newer to options and if you're a stock investor and you're just looking to find a way to hedge your portfolio, make sure you watch the recording before you start trading some of these strategies using options play. So today what we're going to do is we're going to cover, what is a portfolio hedge, who uses a portfolio hedge, how to effectively hedge your portfolio using options, and then lastly, we'll talk a little bit about hedging best practices. But I really want to spend the time showing you guys real examples using options play so that you can see how your portfolio will perform with and without a hedge, so that you can see the difference between the two, because hedging is not necessarily for everyone. It's not necessarily for every market correction. So it's really important to understand and know how to analyze a hedge so that you can decide, is this something that I want to place on my portfolio? So before I get started, I'm just going to put up a poll here real quick. I just want to gauge, the temperature of the room here. Are you concerned about a market correction in the next couple of months of 5% or greater? I want to get a feel for how many people feel that the markets are going to correct and how many people feel that the markets will simply continue higher. Very interesting. This was actually a little bit more bearish than I thought. So about 75% of you so far are concerned about a correction. So about 70% of you are concerned about a correction so far. About a third of you feel that the markets will continue higher. This webinar is really for those of you who expect a market correction. It doesn't have to be today. It can be whenever you feel the markets are going to correct. This is what we're going to teach you here today. It's going to be applicable whenever that happens. Okay, so you might end up coming back to this webinar 3 months later, watching the recording when at that point you feel the markets are going to correct. So that's really what we're here to do, is help you guys understand what to look at if you feel the market's going to correct. So exactly 2/3 of you feel that you're concerned about a correction, and about a third of you expect that the markets will continue higher. So great. Let's go ahead and get started and talk about how to go about hedging your portfolio using options. For those of you that are brand new to options play, welcome. Today we're going to spend about 10 to 15 minutes using the slides, but most of the webinar we're going to spend using options play to show you how to actually analyze a hedge and decide whether it's a strategy that you want to deploy for your portfolio. So we're going to start off talking about what is a portfolio hedge. It's really simple. It's taking your existing stock portfolio, so anyone that has stocks, ETFs, any type of securities in your portfolio, what you're going to do is you're going to buy a put on an index or an ETF, because you feel that the markets are going to correct lower, and that is what ends up is your hedged portfolio. So your stock position here on the left, as you can see, this is what a stock portfolio looks like as the stock stocks go higher, you make a profit. As the stocks go lower, you have losses. And the P&L chart is linear because it's dollar for dollar based on the amount of money that you are invested in the account. When you're buying a put, you're effectively making money if the stock goes lower. So you actually make a profit on the put if the stock goes lower, and you lose money if the stock goes higher when you're buying a put. And the combination of the two results in allowing you to effectively take advantage of a stock move higher. So as the stock market continues to move higher, you make money. However, if the stock market continues to move lower, you actually cap your risk. So you want to reduce the amount of risk that you have in your portfolio if the market continues going significantly lower. So that's really the benefit of a hedge portfolio, is it allows you to take advantage of the upside if stocks continue to go higher. But if stocks actually move lower, you reduce the amount of risk, or you actually cap the risk that you have on your hedged portfolio. So this is really why you want to buy a put to consider hedging your portfolio if you feel that the markets are going to go lower. So let's talk about who uses a portfolio hedge, meaning what position do you have to be in order to utilize a portfolio hedge. And number one, it's for any investor with a portfolio of stocks or ETFs. What this means is that if you only own one stock or two stocks in your portfolio, this is probably not the strategy for you. You might want to just buy puts on the stocks that you own. This is really for those of you that have a basket or maybe a diversified portfolio of stocks or ETFs. Then you might want to consider doing what we're doing today. Again, if you only have a single stock, or if you have concentrated stock position in a single stock, you might want to just buy puts in that underlying stock. You use it to protect against a correction greater than 3 to 5%. And the reason I'm saying that this is only used if you expect a correction greater than 3 to 5% is because most portfolio hedges will cost you anywhere between 1 to 3% of your portfolio value. So unless you expect a move of greater than 3 to 5%, it's simply not worth the amount of money you're going to spend to hedge your portfolio. So think about buying an insurance policy, right? If it costs you 1% of the value of the thing that you're insuring, but you don't think you're going to lose that thing, you're not going to buy insurance on it. So it's really dependent on how far do you think the markets are going to correct versus how much it costs you to buy that insurance. And lastly, it's for those of you that expect a correction in a portfolio of stocks that you own and you do not wish to sell any of your holdings. So for those of you that own dividend paying stocks and you want to continue collecting those dividends, or maybe stocks that you've owned for a long time and you don't want to get rid of it because you plan on holding on to it and giving it to someone when you pass, these are the types of holdings that you would typically want to use a portfolio hedge on. What I mean by that is if you don't mind selling your stock, right, then that's a much better hedge. Simply selling your stock, putting into cash, and then buying it back when you feel the markets are corrected. That's a much more efficient hedge. But if you don't want to sell your stocks, this is really where you want to use a portfolio hedge. So just to understand what that actually provides you, number one, it creates an imperfect partial hedge. So this is a strategy that will give you a partial hedge. It's not a good dollar for dollar hedge. Again, if you're looking for a perfect dollar for dollar hedge, the best thing to do is simply sell your position, sit in cash until you feel the markets are going to resume going higher again. This type of strategy does add additional drag to your portfolio because, again, it costs money to buy insurance on your portfolio. So this cost creates a drag on your portfolio. And the third thing to understand is that your portfolio will underperform from constant hedging. So this is not something you want to do all the time. You don't want to constantly be buying insurance. You want to only do it when you feel the markets are going to correct and you want to get in and out of the trade very, very quickly. So let's talk a little bit about how to hedge your portfolio efficiently using the strategy that we just explained to you. So the strategy itself is actually fairly simple. So if you understand basic calls and puts, you have a pretty good understanding of how to hedge your portfolio. So what we're really going to spend the time is talking about the mechanics of how to set up a hedge for your portfolio. So number one, you start off by buying either puts or put spreads on an ETF or index option. So this could be anything like SPY, QQQ, IWM, XLF, or even some of the index options like SPX, NDX. We'll get a little bit into the details of how to select which instrument for your portfolio in the next slide. But the key thing here is just simply buying puts or put spreads on any broad-based ETF or index. And the key here is selecting an ETF or index that tracks your portfolio. Again, we're going to get into that a little bit on the next slide. The second piece that you need to do is selecting an expiration date. So when you're hedging your portfolio, you generally want to go about 1 to 2 months beyond your horizon. So if you expect the markets to correct over the next 2 months, you might want to select a 3 or 4 month expiration date. The reason for this is because number one, it's really difficult to call corrections timing. So a lot of times it can take a little longer than you expect. It sometimes take a little shorter than you expect. You want to give yourself a bit of a buffer beyond what you expect so that if the market corrects for 3 months instead of 2, you have a buffer. Number two, the longer you go out, the less time value is working against you because time value erodes faster as you get closer to expiration. So when you trade a longer dated option, the effect of time value that's working against you is actually mitigated a little when you're going further out in time. So even though it costs a little bit more money to buy long-term insurance, but if the market corrects in 2 months and you bought a 4-month put, you can always sell the put 2 months into it. But during those 2 months that you're in the put, you're actually experiencing less time decay on that put when you're buying a longer dated put. So that's why when you're hedging, you generally want to mitigate that time decay on your option. And one way to do that is by going a little further out in time. When it comes to strike prices, it really depends on how aggressive of a hedge you need. Okay, so if you really want as close to dollar for dollar hedge and you want a very aggressive hedge, you want to buy in the money puts. This is generally more expensive to do versus someone who wants a more conservative hedge. So if you're just expecting a modest move where you don't necessarily need to have dollar for dollar protection, you would use a conservative hedge by buying out of the money puts. And this is a bit cheaper to do. Okay, so think about buying like expensive insurance versus cheap insurance. It depends on what you're looking for. They have different costs. So selecting in the money puts will give you more expensive or better protection, and out of the money puts gives you cheaper but less protection. And lastly, selecting the number of contracts, it should be based on your portfolio value. So if you have $500,000 portfolio, you want to calculate the number of contracts based on that. So I'll show you how to use the contract calculator and options play to select the right amount of contracts depending on what instrument you use for your trading. So I want to talk a little bit about the best practices. So now that we understand what strategy to use, what expiration, what strike prices to choose, and calculate the number of contracts, I want to talk a little bit about the mechanics of entering and exit a portfolio hedge. And I think the first and most important thing for everyone to understand when you're hedging your portfolio is that hedging is expensive. It is not cheap. So this is why you only want to do it when you're expecting a fairly severe market correction and you want to remain invested in your stocks. So time value is always working against you when you buy a put. So it's really important to, number one, enter at the beginning of a correction, meaning don't do it before you think it's going to correct. Only enter the trade once the correction has begun. Number two, you want to exit the trade very, very quickly. So if the correction begins and you've hit that market bottom that you're expecting, exit the trade immediately, exit the put immediately. Even if you still have 3 months left on the put, exit that trade immediately. Or if you're completely wrong on your expectations of a market correction, so if SPY is at 270 like it is right now, and you think it's going to move lower, but 2 weeks later it's at 280 or 290, get out immediately because you're losing money on the hedge. And that's really what causes underperformance of portfolios in the long run. So make sure you understand that hedging is expensive and time value is the one thing that's working against you. So make sure you enter when you expect a correction to begin and exit as soon as you feel that the correction has ended, or if the correction never simply materializes to begin with, okay? Number two, because it's expensive, you can actually help offset the cost of a hedge by selling covered calls. So if you own a bunch of stocks and ETFs in your account and you're buying one put to hedge your portfolio, you should be selling covered calls on the individual stocks in your portfolio to offset the cost of that hedge. That's one way to bring the cost of buying insurance down. So some of you may be familiar with a strategy called a collar, and that's really exactly what this is selling a covered call to buy a put. But instead of doing a put on the individual stocks, you're buying one put on the overall market to hedge your entire portfolio, but you need to sell cover calls on the individual holdings that you have in your portfolio. So that's one way you can offset the cost or the expensive insurance that you need to buy when you're hedging your portfolio. The second piece is that you can choose between trading ETF options or index options. However, index options does have preferred tax treatment. This is something that many people may not be aware of. But when you buy an index option like an SPX versus SPY or an NDX versus QQQ, which are both the same thing, just one's an ETF and one's the index, is that the index option has what's called the 60-40 tax preferential treatment. So 60% of the capital gains in a index option is taxed at short-term capital gain, 40% is taxed at long-term capital gain. So that means the highest effective tax rate you will pay on an index option is only 23% versus almost 40% on a ETF option. So this is one way to also, again, reduce the cost of hedging your portfolio because it is expensive. And index options, a lot of people can't trade them when they're speculating because the sizes of them are so large. But when you're hedging an entire portfolio, a lot of times you may have the number of contracts to trade an index option. So if you've never traded index options, but you're interested in hedging your portfolio, this might be one of those times to consider taking a look at them. Lastly, you want to use an instrument that's based on your portfolio. Okay, so this means that if you have a relatively diversified, broad-based portfolio, so you have either a bunch of different stocks across all the different sectors, or if you have a diversified portfolio using index ETFs, then you want to use what we consider a broad-based index. So SPX, S&P 500 index option, SPY, which is the S&P 500 ETF, IWM, which is the Russell 2000 ETF. All of these are generally good for if you have a balanced, broad-based, diversified portfolio. Versus for those of you that may have a specific sector that's tech, that's heavy in your portfolio, such as tech, right? A lot of people have big tech names: Apple, Facebook, Amazon, Netflix, Google. These are the types of stocks that a lot of people have quite a bit of concentration in their portfolio. If that's the case, then you might want to use a tech-based index. So, for example, NDX, which is the NASDAQ 100 index option, QQQ, which is NASDAQ 100 ETF, or XLK, which is the sector ETF for technology. You can use any of the sector ETFs. If, let's say, you have a portfolio in industrial stocks or utility stocks, you might want to use XLI or XLU. Any of these things that are more correlated to your portfolio, the more highly correlated, the better hedge you're going to receive. And lastly, for those of you that are maybe a bit older and you don't have a lot of equities, you have a lot of fixed income or bonds in your portfolio, you might want to select things like BND, TLT, LQD, all of these types of bond ETFs that will provide you better hedges for your portfolio. So it's important to understand what your portfolio consists of. If you don't know that, you might want to plug your portfolio into a tool like Morningstar that will help break down your portfolio. Really interesting tools. There are plenty of tools out there that will give you an idea as far as what your portfolio currently holdings has, and maybe helping you select the appropriate ETF or index to hedge your portfolio with. So with that, what I really want to do is go through some real examples using options play and showing you how these strategies perform based on your views of the overall market. So let's take a look at SPY. I'm using SPY as a proxy for the markets. You can use any ETF that's more closely tied to your portfolio. So again, if you have a tech portfolio, you might want to use QQQ. And maybe if I have time, I'll go through that as well. So what I have here is I have your portfolio right here. What I'm going to do is I'm going to set up two possible hedges against that. So I'm going to buy a put and I'm going to buy another put, and I'll have different puts to show you the difference between what I consider an aggressive hedge versus a conservative hedge so that you guys can see the difference, okay? So I'm going to select an expiration date. Let's say I select a August expiration, so that's about 3 months out. So maybe I expect a correction in the next over 2 months. And again, this is not a recommendation or saying that we expect a correction. This is just saying if you expect a correction, here's some things that you can do. So let's compare buying in August. So the SPY is trading at 272 right now. So let's take a look at buying a out of the money call, a 267, so $5 below the current price, and then a strike price of 277, $5 above the current price. So let's take a look at this. Now, like I said, based on the this slide here, I'm telling you to look at expirations 1 to 2 months beyond the horizon. That's why I selected a September expiration. If I expect a correction over the next 2 months, I'm selecting 1 month beyond that. And strike prices, like I said, you want to select an aggressive hedge. You want to do in the money puts, and conservative hedge, you want to do out of the money puts. So those are the two things that I've selected in terms of strike prices. And lastly, you want to select the number of contracts using your portfolio value. So I want to show you how to use our tool to do that. So for those of you that are new to options play, there is different tabs here at the bottom that are designed to help you adjust each one of these strategies. And one of these things is called the risk and investment calculator. It's the third dot from the bottom for those of you that have never used this. And what you want to do is you want to use the invest button. So you definitely want to use put in your portfolio value here. This is how much your portfolio is worth today. So if let's say you have a $300,000 portfolio, you can put that in. And what that does is it simulates what your portfolio would cost. So it would cost you around 1,100 shares of SPY is a $300,000 portfolio. And what it does is it calculates the appropriate number of contracts for you to trade in order to hedge that portfolio. So it's 11 contracts of the August 267 puts and 11 contracts of the August 277 puts. So one that's $5 in the money and one that's $5 out of the money. And let's take a look at how this performs. So this is a $300,000 portfolio. To buy a conservative hedge costs you $5,700. So a little about 1.5% of your portfolio value. And here is 10%, so roughly about 3% of your portfolio value. So a conservative hedge is about 1.5%. A aggressive hedge is roughly 3%. So let's actually see how do these strategies perform if the market goes higher, if the market stays where it is, or if the market goes lower. So we're going to use our P&L simulator. This is something that we go over a lot in many of our webinars. So today we're going to show you how to use the P&L simulator for your hedging strategy. So first, let's focus on the unhedged portfolio. So this represents your current portfolio that has no hedges on it, right? And what it does is if the stock markets go higher, you make money. If the stock markets go lower, you lose money. It's a very simple calculator that allows you to understand how your portfolio performs without a hedge, right? And that's really what we see here on the left. And now what we're going to look at is how do these two hedges, the conservative hedge and the aggressive hedge, perform as the markets move. So number one, what we're going to do is what happens if on expiration, and maybe we can change the date. So let's say we change the date to the end of July, right? So let's say, around August 1st, what happens if the market stays exactly where it is? What are my expected losses? So here, if the markets are flat, you don't make or lose any money from your current portfolio. But if you had bought this conservative hedge, you'd lose $4,400. If you bought this aggressive hedge, you actually only lose $3,300. This is another interesting thing about the difference between buying an in the money versus buying an out of the money option. When you're buying an in the money option, time decay works less against you than it does when you're trading an out of the money option, because when you're trading an out of the money option, all of that value is extrinsic value, and you're going to lose that faster than the intrinsic value that you have on in the money put. So actually, even though this costs more and you'd expect to risk more if the stock market goes against you, it actually ends up losing you less money in the short run. Okay, so only in the long run do you end up potentially losing more money. But this tool is really designed to allow you to create any different scenarios and see how much am I actually making or losing from these hedges, right? So if at expiration date, the stock stays exactly where it is, or the market stays exactly where it is, you're going to see a roughly 5,700 loss on the out of the money put. So you lose everything on the conservative hedge. Versus if you bought an in the money hedge, a more expensive hedge, you actually lose less money. So you lose $5,700 here versus only $4,700. And this is really comes down to the fact that when you're buying an out of the money option, all of that is an extrinsic value versus when you're buying in the money, you have both intrinsic and extrinsic. So you're actually losing less money to extrinsic value when you buy this in the money hedge. So this is really why when you're hedging, I generally prefer to buy slightly in the money puts, even though it costs more money. But if the market stays where it is, I actually lose a little less money. And if the market goes lower, so let's take a look at what happens if the markets go lower. So let's say what happens if the market goes down 5%. If it goes down 5%, here my portfolio loses 5%. So I'm losing $14,000 out of my $300,000 portfolio if the market goes down 5%. So let's take a look at how these two hedges help offset those losses. So if I bought a conservative hedge here, I'd make a $3,400 return on this put. So I've offset the $15,000 loss with $3,500. So I'm really only down about $11,500 with this conservative hedge. So if I bought this insurance that cost me 1.5% of my underlying portfolio value, I've hedged approximately a little under a third of the losses that I have from the portfolio. Versus here, if I bought the more aggressive hedge, it cost me $10,000 as opposed to $5,000, but I'm now hedged $10,000. So here I've lost $15,000 on the portfolio, but I've made $10,000 of that back on the put. So I've only actually lost $5,000 as opposed to $15,000. So this is how you can use our tool. You can select different expiration dates, different strike prices, and see how does this portfolio actually perform if the market moves lower, if the market moves higher, and gives you approximately what your hedge would be if you had bought these puts for your portfolio. Okay, so and you can continue to do this and say what happens when the market really goes down, right? Let's say it goes down 10% here. So if the market moves down 10% here on the stock on my portfolio, I lose $30,000 if the market corrects 10%. Here, I made an $18,000 profit on my out of the money put, the conservative hedge. So I've hedged roughly 2/3 of the cost, right? So $30,000 I've lost on the portfolio. I've made $18,000 back on the hedge. So I'm out about $12,000 on my overall portfolio as opposed to $30,000. Versus if I bought the more expensive insurance policy, here I'm hedged $25,000. So only about a $5,000 difference between my portfolio and what I've made on the hedge. So this is where you can sort of see which strategy is best suited for you. Okay, so do you want to pay for the more expensive insurance and get better coverage, or are you okay with the cheaper insurance that gives you a decent hedge if the market really moves significantly lower, right? So here, the out of money, the cheaper hedge really only works when you're expecting a very large move. If you're expecting a fairly modest move, the more expensive option a lot of times is the better option, even though it costs more. And part of it is because even if the market stays where it is, you're actually losing less money on the expensive insurance policy versus the cheaper insurance policy because of the fact that when you're buying an out of the money put, all of that is extrinsic value. Okay, so this is how you can use our tool to say also what happens if I'm completely wrong and the market shoots higher 10%. So if the market shoots higher 10%, here you make a $30,000 profit on your portfolio, but now you've lost $5,000 because you've purchased this hedge and it's gone nowhere. So you've lost 1.5% of your portfolio. And if you bought this more expensive one, you lose $10,000. So instead of making $30,000 here, you make $25,000 if you bought the cheap hedge, and you only make $20,000 if you bought the expensive hedge. So again, this allows you to understand what happens if the markets go higher, what happens if the market stays where it is, or what happens if the market. And ask yourself, hey, do I think the market's going to correct? If I do think so, how far do I think 50? Well, then here I've lost $24,000 on my portfolio, but I've made half of that back on the cheap hedge, and I've made 2/3 of that back on the expensive hedge. And you can ask yourself, well, which one do I think is better, right? So you might want to say, well, since it cost me $5,000 less, I'm okay with, a cheaper insurance policy because, it still gives me a pretty good hedge. It hedges half my cost, right? Or half my losses on the portfolio versus the more expensive hedge gives me an extra $5,000, but I'm also paying $5,000 for it. So maybe not worth your while. So this is really the type of analysis that our P&L simulator allows you to do to quickly see what portfolio is best suited for me. So let's just take a look at QQQ, right? Because a lot of you guys have a tech-heavy portfolio. So I want to take a look at how does this perform if some of the tech names in your portfolio really starts to pull back, which is something that we saw in just a few weeks ago. Some of the heaviest losses were some of the big tech names. So that's still, I think, in a lot of people's minds that's a possibility. So I want to take a look at how each one performs. So let's take a look at maybe a July expiration. So maybe you expect a quicker move on the hedge for the tech names. So let's look at the July's trading at basically 170 right now. So let's take a look at the 175 put versus a 165 put. So here I have set up, here's your current portfolio right now. Here's a conservative hedge. Here's a more expensive hedge. And let's, again, put in the P&L using the risk and investment calculator. Let's say this time you have a $500,000 portfolio in a fairly tech-heavy name. And here you have, or let's just do $1 million as a round number. Let's say you have $1 million portfolio. Here it costs you $17,000 to hedge your $1 million portfolio, so roughly 1.7%, versus the more expensive insurance policy costing you $43,000, so 4.3% of your overall portfolio to buy the more expensive hedge. So let's take a look at how these will perform. So if the markets stay exactly where it is, your portfolio here would have roughly a 0% return. But if you had bought this cheap hedge, you lose $17,000, basically your entire portfolio, 1.7% of it. If you bought the more expensive hedge, even though it costs you 3 times as much, you actually end up losing less money. So you're actually only losing $11,000. So you're only losing 1% of your portfolio if you had bought the more expensive insurance policy. So that's an interesting thing to understand, right? So a lot of people feel that, hey, I want to buy cheap insurance policies, but the more expensive one sometimes is better for you, even if the market stays where it is. And this is really one of the reasons why. And then you can sort of say, well, what happens if the markets move lower? How do I make money? So as you can see, the more expensive hedge starts giving you profits immediately. So even if the markets move just 3% down, you're actually going to hedge a decent portion of your losses. So you lose $31,000 here on the hedge if the market moves down 3%, but you've made back 2/3 of that because you made a $20,000 profit on the more expensive insurance policy. And you can really see how each one of these performs. So as you can see, the market needs to move down to about 161, so about a 5% correction before the cheaper hedge starts to work. So here you've already lost $46,000 before this cheap hedge really starts to come in, versus this is already up $34,000. So your hedge almost dollar for dollar here with the more expensive hedge. And then as the stock market continues to move higher, or continues to move significantly lower, that's when this starts to catch up. So again, if you expect a very, very large move, that's when you might want to consider buying the cheaper insurance actually. But if you expect a fairly modest move, or if you expect the move to be a little slower, you might want to consider buying the more expensive policy because, again, it provides you better protection. So here I've lost $126,000 on the portfolio, but I've gained $115 of that back. So I've only lost about $10,000 versus $126,000. And here I made $81,000 back. So I'm still losing roughly $40,000 or so on the cheaper hedge. So this is really designed so that you can see how each one of these strategies perform. And as you can see, if the market really takes off and goes up 10%, here I make $99,000 or $100,000 on the portfolio, but I've lost 17 and I've lost 43 on on the two insurance policies. So this allows you to very quickly look at different strike prices, different expiration dates, different contract sizes, and actually see how much are you actually hedged if the market goes down 10%, if it goes up 10%, and all of those different scenarios. So with that, what I really want to do is just do a quick recap. If you're looking to hedge your portfolio, again, this is really only for those of you that have a portfolio with a basket of different stocks and ETFs, and you only use it if you expect at least a 3 to 5% correction. If you only expect a 1 or 2% correction, this is not the strategy to do. And you only do it if you do not wish to sell any of your holdings. If you're okay with selling your holdings, you're better off doing that, sitting in cash and then buying it back when you expect the markets to continue going higher. That's a much better hedge than buying puts. So buying puts is really only for those of you that don't want to sell your holdings because you need them for dividends, or you don't want to get a tax bill. Then you want to consider using this type of hedge that we're talking about. And when you're selecting your index, your instrument, make sure you use an instrument that closely matches your portfolio. If you have questions about that, let us know. We can help point you in the right direction for that. And you want to choose expirations that's 1 to 2 months out beyond your time horizon. Choose strike prices. Aggressive hedges that are more expensive sometimes can be better. Conservative ones are cheaper, but they do have their drawdowns, if you will. And then lastly, you might want to make sure you select the appropriate number of contracts based on the value of your portfolio. That's one of the most important pieces here. So with that, what I'll do is I will open this up for Q&A. Please type your questions into the chat window, and I will answer as many questions as we have time for. I have a question here. What's the max time you recommend? I generally don't recommend buying puts more than 3 to 4 months out because you never want to be, like I said, buying insurance is expensive. You don't want to just be sitting on that insurance policy because that insurance policy is constantly eroding against you. So that's why, generally speaking, you don't want to be in a trade for more than you don't want to buy a hedge that's more than 3 to 4 months out, and you generally want to get out as soon as the move happens. So if the move happens in 2 weeks, you want to get out after 2 weeks, even though you've bought a 3-month put. So here, let's just take a look at this, right? So even if I expect the markets to correct 10% in the next 2 weeks, I'm seeing that here I've lost $100,000 on the portfolio. I've made $56,000 back with the cheap hedge. I've made $87,000 back with the expensive hedge. So notice how even if the stock moves significantly lower, I can still effectively hedge with a 4-month option or 3-month option, even though I expect the move to happen in 2 weeks. So that's why we generally recommend doing that. Carlos is asking, why not sell calls? You absolutely should sell calls to help you offset the trade. The reason that you can't just sell cover calls alone is because the income that you receive on a cover call many times is, like you said, 0.36% by selling a cover call. So your downside protection is limited to 0.3% over the next 22 days, or an annualized offset of about 6%. So unless you expect a correction to be less than 6%, cover calls is not going to be enough of a hedge. So, this is really for those of you that are expecting a large move down. That's why you want to use buying a put. Now, again, you can sell calls against that to offset the cost of buying that put. And that is something that you should consider to offset the cost. What about buying an in-the-money put and selling an out-of-the-money put to fund? Absolutely. So you can do that. That's a great question. So in the example that I gave here, we were looking at long puts. But you can also sell a put against it. So let's say we're looking at buying the 175 puts. We can sell a 160, let's sell one that's 1 standard deviation away. So let's sell the 161 put against that. So you can certainly do that, and that also helps offset the cost of the trade. The only key difference between doing that versus buying a put, so let me look at buying a put here Let me show you the difference. So here I have buying the 100 shares, or here I have the portfolio. Here I've bought a put, and here I've bought a put vertical. The difference between the put and the put vertical is if you expect the move to happen very quickly, the put vertical will not be as good of a hedge as just simply buying the put. So even though it costs you less money, you're actually going to receive less of a hedge than just a long put. Now, if you expect the move to happen over a long period of time, then yes, the put vertical sometimes can be better. But if you expect a quick move down, the put will give you the better hedge. So that's why, generally speaking, you use puts. You can use put verticals in certain instances. So that's actually a good question, Ken. Thanks for that. What is the use of volatility slider and how you use that in conjunction with other tools? So generally speaking, when the market corrects lower, volatility actually increases. So that's one of the ways that you can use this slider. Now, the reason I didn't get into this because that's a bit of an advanced topic, and the actual impact to the volatility increasing is actually not a huge amount. So as you can see, if volatility stays where it is, you have 116% return versus if the volatility really explodes 50% higher, you're still only looking at 124% return. So it's not a huge impact to your bottom line, but it is here for those of you that are a bit more advanced and want to see how does volatility actually affect your option pricing. So because we know that when markets go lower, volatility shoots higher. And this is one of the ways that you can kind of see how that performs for your hedge. Question here is how to hedge for mixed sector portfolio and for stocks with high beta. So again, if you have a mixed sector portfolio, the best thing to do is SPY. And if you have a high beta, so if you have a beta of 2 as opposed to 1, then you can simply just double the number of contracts. So for example, if let's say we have a hedge here, so let's take a look at a long put versus another long put. And let's say you have, a $200,000 portfolio. So normally this is telling you to buy 7 contracts of the puts to hedge your $200,000 portfolio. But if let's say you have a beta of 2, then you might want to double the contract. So you can simply just say, well, I'm going to do 14 contracts because I have a beta of 2. That's one of the easier ways for you to adjust your contracts for a higher beta portfolio. Great question. How do I automate my option writing using options play? Great question, but a slightly off topic for our webinar today. We have a specific webinar on income strategies that actually shows you how to automate your strategies using our income tab to sell covered calls against your portfolio. If you want, shoot me an email after the webinar and I'll be able to send you that recording. And lastly, what if my broker does not allow me to sell calls or puts? Well, then you should talk to your broker and try to get clearance for it. But you should be able to sell cover calls because that is the first level of clearance that you're going to get by trading options. You can't, if you can buy puts and calls, then you can definitely sell cover calls. So you should be able to do that. That shouldn't be a problem. But if you have any questions specifically regarding that, please shoot me an email with who your broker is, and I'll try to do my best to help you with that. So that's all the questions that I've received so far. Is there any other questions? Is it advantageous to use inverse ETFs rather than index? So almost never, because if you read the perspective of these inverse ETFs, you'll see that they don't provide a good hedge. They only provide a hedge over a one-day trading period. Meaning if you're expecting to hedge anything more than 1 day, this starts to provide a portfolio drag. So you can use them if you're expecting a very, very short-term move against you, absolutely. But anything beyond 1 day, that's not what it's designed for. And partially it's because it costs them money to short these stocks on margin with leverage. And that cost is passed on to you. It's much better to use a straight put on your portfolio if you're looking to hedge that. And again, if you're trying to simply hedge your portfolio dollar for dollar and you don't want to buy puts, the best thing to do is just simply sell your stock or your ETF and sit in cash until you think the market's going to continue higher. That is by far the best hedge that you can do for your portfolio. But if you can't do that because you can't sell your stock, or if you don't want to sell your stock, buying a put is your next best alternative. Well, options on those inverse ETFs are even worse because now you're applying a derivative on a derivative, and all of those costs are being passed on to you. And it's simply just not cost efficient to use them as a hedge. Buying contra ETFs. What's a contra ETF? I'm not sure what that means. If you're referring to a short ETF, I think I've just covered that in what I just explained. Any other questions? If there are no more questions, I certainly appreciate you guys taking the time out this afternoon and coming and listening to this topic that may not necessarily be as relevant today as it was 2 weeks ago, but I really hope that you guys found some useful information for when it does come time that you expect a correction in the markets. Use our tool. It's designed to help you quickly find which puts to buy to hedge your portfolio and easily calculate what your expected return would be or how much your portfolio would be hedged by for any downturn in the markets. So especially for those of you that are kind of tactical with your portfolios and you like to position different market conditions, this is a great way to potentially hedge your portfolio during a 5-10% type of correction. If you're expecting a 30-50% correction, you might be better off just selling your stocks sitting in cash. But if you're expecting a 3 to 5-10% correction, this is a great way for you to maintain invested in your portfolio while buying some protection for a relatively cheap price. So with that, this webinar is recorded. Thank you very much for attending. You will get the recording in about an hour or so once we finish processing that. And I will be back in 2 weeks. I'm sorry, next week, doing another webinar, and I hope to see all of you there. Thanks for taking the time out, and I hope you guys have a great afternoon.